Hi everyone and welcome back. In this video, we're going to start chapter 6 by talking about income for a Schedule C trader business. This is an important shift in the course because up to this point, we've mostly focused on individual income and deductions. Now we're starting to look at self-employment income, which introduces a whole new layer of complexity. So let's start with the basic question. What actually counts as a trader business? So a trader business is any activity that is engaged in for profit. And that phrase, engaged in for profit, is really important. It means that the taxpayer is actually trying to make money, not just doing something for fun or as a hobby. If an activity is engaged in for profit, then the income and expenses from that activity are reported on Schedule C. So when you hear Schedule C, you should immediately think self-employed business activity. Now let's connect this to the tax return. Schedule C calculates the profit or loss from the business, and that number ultimately flows to Schedule 1, line 3, and then into the taxpayer's overall income. So this is how business income becomes part of the individual tax return. Now let's talk about what counts as income for a Schedule C business. The key term here is gross receipts. Gross receipts include essentially all income received from the business. This includes direct sales to customers, payments for services, income earned as an independent contractor, and amounts reported to a taxpayer as a statutory employee. So the idea is very broad. If the business receives money, it's generally included in income. Now in practice, a lot of self-employed individuals receive a Form 1099 NEC. This form reports non-employee compensation, which is paid to independent contractors. So if someone is working as a freelancer, consultant, or contractor, they're often going to receive a 1099 NEC. But here's the important point. The amount on the 1099 NEC is not the only income they report. Students often assume that, hey, if it's not on a 1099, I don't need to include it. And that is not correct. All income earned in the business must be reported whether or not the Form 1099 was issued. So, super simple example, suppose a taxpayer receives $5,000 reported on a 1099 NEC and $2,000 of cash payments from clients that were not reported on a Form 1099. When we look at Schedule C, the total income that we need to report there is $7,000, not just the $5,000 from the 1099. So again, 1099s, they help report income, but they do not define total income. You may also see the term statutory employee. These are workers who receive a W-2 but are treated like self-employed, are treated as self-employed for tax purposes. In those cases, their income is still reported on Schedule C, even though they receive a W-2. Now, you don't need to go too deep into that right now. I just want you to be aware that it does exist. Now let's shift slightly and talk about something that reduces income, which is cost of goods sold. Surely by this time in your accounting career, this isn't a new term for you. But again, if a business sells products, not just services, they're going to have a cost associated with producing or purchasing those products. Cost of goods sold is subtracted from sales to arrive at your gross profit. So instead of taxing your total sales, the tax system allows businesses to subtract the cost of the items that they sold. So another very, very easy example, let's say a business has $100,000 in sales and they have $40,000 in cost of goods sold. Their gross profit is going to be $60,000. And that's what the business is going to be taxed on, the $60,000, not the total sales amount. Now, of course, that was just a very easy example. Certainly, you're going to have other expenses associated with those sales besides just cost of goods sold. But the point being is that the taxable amount is the sales less the expenses that are reasonable and necessary to generate that income. Now let's talk about how income is recognized, which brings us to accounting methods. Most Schedule Cs use the cash method of accounting, and under the cash method, income is recognized when it's received, expenses are deductible when they are paid, and this is the simplest and most common method. However, in some cases, businesses are required to use the accrual method. This generally applies when their gross receipts exceed 31 million and inventory is a material factor in the business. Now, you wouldn't really often see this in practice where you've got someone with gross receipts in excess of 31 million or even close to that, that they're either using the cash basis or that they're reporting their income on Schedule C. For legal purposes, you're likely going to set up a separate entity if you have income that is that significant. But as you know, under the accrual method, income is recognized when it is earned and expenses are recognized when they are incurred. So timing can be different compared to the cash method. So now you may be thinking, why does this matter? It matters because the accounting method determines when income is reported, and that can affect your taxable income and timing of taxes and also planning opportunities. For this course, just focus on the fact that most small businesses use the cash method and larger businesses may be required to use the accrual method. So if we take a step back, here's the big picture for Schedule C. First, determine whether the activity is a trade or business. So it's not a hobby, it's not just something you're doing for fun, it's not something that you're purposely generating a loss for so that you can offset other income. This is an actual trade or business. Next, you want to figure out what all of your gross receipts were, regardless of whether they were reported on a Form 1099. After that, you're going to subtract your cost of goods sold, if applicable, and any other expenses. And you'll also need to determine your appropriate accounting method to determine timing. So let me quickly point out a few things that students often get wrong here. Again, driving home that point that thinking only 1099 income is reportable. It doesn't matter if it was on a 1099 or not. All gross receipts need to be reported on Schedule C. So forgetting to include that cash income is a common mistake. Confusing W-2 wages with Schedule C income is another common mistake, and then not understanding the difference between cash and accrual. If you avoid these common mistakes, you'll be in great shape. So that brings us to the end of this first video for Chapter 6. In the next video, we'll move to ordinary and necessary business expenses. But as you go through the material, focus on what qualifies as a trade or business, what counts as income, and how that income is reported on Schedule C. As always, if you have questions, don't hesitate to reach out. Thanks.